Welcome to The Value of Knowing, the podcast where we dive deep into the world of legal complexity and opportunity on the vibrant continent of Africa. Stay tuned for expert insights and a closer look at the legal landscape in Africa, where Bowmans helps its clients to manage legal complexity and unlock opportunity. That's the value of knowing.
I'm your host, Michael Avery, financial journalist, columnist, and multimedia guy. Let's introduce our panelists today. First up, we've got Jo Mitchell-Marais, Deloitte Southern Africa turnaround and restructuring leader. Jo is a well-recognized subject matter expert in the industry, will be a familiar face, frequently speaking at local and Africa-related conferences. She recently re-entered the advisory domain at Deloitte and is armed with 19 years of financial services industry experience. Don't want to give too much of your age away here, Jo, but you certainly bring significant lender-side perspective to the service offering, having led teams in a leading local South African bank. And as we know, if you owe the bank $1 million, it's your problem. If you owe the bank $1 billion, well, it's the bank's problem as well. Also a UK chartered accountant by qualification and serving as a board member of SARIPA, the South African Restructuring and Insolvency Practitioners Association. Jo was also recently awarded her Insol Fellow designation. And then we've got Stefan Smyth, who's a managing director in the Restructuring Advisory Practice at Kroll, based in Johannesburg. Stefan leverages more than 25 years of work experience working in the UK and indeed here in South Africa more recently. He's advised lenders and companies across the region of sub-Saharan Africa for over 14 years on a range of very complex restructuring and reorganization matters. I think many will be familiar with the Stair Kennycore Theatres matter, which was the largest cinema chain in South Africa, to come out of the COVID period in a very notable business rescue success. He's also the official receiver of Mayfair Holdings and Mayfair Speculators and served as a trustee for matters for the Competition Commission as well. So, Stefan, great to have you with us. Also around the table, we've got Joyce Mbui, who is a partner in the Bowmans Kenya office. She specializes in financing, capital markets, insolvency, restructuring, and corporate and commercial law, and is a qualified English solicitor, as well as an advocate of the High Court of Kenya as well, and a member of the Law Society of Kenya and the Law Society of England and Wales. So, Joyce, I've got to say, jumbo, thanks for joining us today. And then out of South Africa, we've got Tobie Jordaan, a partner and specialist in business rescue, restructuring and insolvency at Bowmans. And Tobie's been on my show a couple of times, a very straight shooter when it comes to the world of business rescue, restructuring and insolvency. So, Tobie, great to see you again, and joined by your colleague, Juliette de Hutton, co-head of restructuring at Bowmans. Also very well known and respected for her technical proficiency and depth of experience. Juliette's advised on some of South Africa's most challenging insolvency and business rescue cases in various sectors: aviation, retail, commercial, property, and also draws on some 20 years experience advising clients in this space. So with that, I don't know how many of you have read The Devil's Financial Dictionary by Jason Zvi. He's a great columnist for the Wall Street Journal, and he produced this book, which is very tongue-in-cheek, but he has this to say about forecasting. It's the attempt to predict the unknowable by measuring the irrelevant, and it's a task that employs most people on Wall Street. And I just think it shows you that, you know, we've got to put all caveats on the table here. When you try and predict the future, there's a great likelihood that something will happen, some black swan event that'll make all your predictions moot by the end of the year. But with that, Jo, kick us off. What can we expect from a South African perspective in the business rescue space, and which sectors are vulnerable right now?
Well, thanks very much, Michael, and good day. So I think that there are two parts to that question. Is what do we think is going to be happening with business rescue? And this is a question that we ask our respondents in our survey every year that we do on the restructuring industry. And last year, 85% of respondents said there's going to be an increase in business rescue activity, and that never materialized. So I would say we're also not that good at forecasting as a profession. We're asking the same question again this year. And once again, we're seeing majority of respondents saying we're expecting an increase, whether it be via a formal mechanism like business rescue or liquidation, or an informal mechanism like a more of a turnaround led by an advisor. But there's definitely a leaning towards there's going to be more distress in the market. Now, when we look at which sectors do we think that that's going to impact, I mean, there are two that sort of stand out for me. Interested to hear what others might have to say, but I think really impacted not just by our homegrown issues, but also by some of the macro issues at play. So a sector like automotive, for example, very reliant on the ports for imports and exports, impacted by what's happening in our local economies, impacted by load shedding. I think it's going to be a real struggle for the automotive industry. And we're seeing, a decline in new vehicle sales coming out in the January data as well.
Yeah, I was just going to add that I was reading an article about affordability in the South African market, and we just haven't seen salaries keep pace also with the increase in new car prices as well. And then in retail.
Yeah, well, retail affected, as you say, by a fall in the real average salary of a South African. So if you go back to about February 2021, that average sort of monthly salary was about 16,000 Rand a month. That has fallen in September 2023 to just over 13,000. So you can see that affordability is playing a part from in a real terms perspective. So any sector that, in my opinion, is reliant on discretionary income is going to struggle as we move into 2024.
Those are two, I think, glaring sectors in terms of where we might see some pain. I've been quite surprised that we've seen the resilience so far in those sectors that we have seen. So I do worry and wonder about how many companies are potentially trading recklessly, or directors maybe exposing themselves to that. Anyway, Stefan, in the UK space, we've got another key election year ahead. What do you expect from 2024?
Yeah, thanks, Michael. I mean, from my perspective, I guess as a Brit and now living and practicing in South Africa, I think there are some natural tendencies to look to the UK market and see what it may well bode for us. The reverse is also true. I think we have vastly different economies. I think whilst we're both looking at similar levels of muted growth of about 1%, I think the socioeconomic situation in both and the recovery of both post-COVID and throughout the uncertainty following the Ukraine war and others is different for us than it is for the UK. But nonetheless, I think large economy, there are some similarities that we tend to follow the trends of. I think in reality, I think property is a big question mark from a UK perspective. They're expecting extreme headwinds in that regard. It was interesting to see the China's Evergrande finally listing towards a liquidation, I think, after years of speculation as to whether or not it'll get repackaged.
Yeah.
I think that's an important warning sign, I think, in terms of the notion of too big to fail. I think if China's coffers won't cover that, I think we're going to see strain in the property markets, both in the UK and certainly in South Africa. Outside of that, I think UK's growth potential is to outstrip what it's currently forecasting. I think ours is unlikely to do so. And therefore, where we think we might be seeing some serious headwinds are really with the kind of stickiness, I suppose, of interest rates. I think there's been lots of focus at a consumer level about the expectations of reductions in interest rates. I think the real view is that by 2025, we're probably going to see some improvements, but certainly not until late this year. I think the effect that will have on a range of industries, particularly the consumer, I think, as Jo alluded to, I think is already under pain in terms of salaries, but also in terms of spending power now is going to be really, really difficult. But I think sectors that we think are going to be hard hit are probably the industrials, those with working capital. So with the high interest rate, the holding cost of your working capital is much higher than it would have been 3 or 4 years ago. And on top of that, I think we've got supply chain issues. So I mean, we have both the rerouting of shipping channels around us that's going to cause us supply chain issues, but I think also in terms of other issues that are more localized. I think the Transnet situation, the major capacity problems we've got at the ports, and the debate whether it's going to be road or rail that is our big infrastructure is the one to watch for industrials who are hugely reliant on the transportation both to and from the ports. So no direct correlation. I think some similarities, but I think really just quite a few unique issues that are doing. I think in terms of the automotive sector, I guess the question I've got is, with the sharp shift in technology, I think in the last couple of weeks we've seen hydrogen taking the mantle already from EV. So those that have invested heavily in EV now flexing and seeing whether they can get to hydrogen. I think the South African motor industry is an export business and is going to have to do some serious work to get fit for the OEMs to be able to continue to support them with new technologies. I think we have a good place currently, but my question mark is, are we good for the next 5 years?
Yeah, and only having recently seen that white paper for EVs published after years of NAMSA calling on government to provide more policy certainty. You know, historically, it's been a standout success feature of government policy, in that automotive industry development program provided that certainty. Much like mining, it's a very capital-intensive, long lead time projects, these for OEMs. So very interesting to see how that'll play out. Joyce, from an East African perspective, I was in Kenya last September, and just a sense here that William Ruto was saying the right things, but still some doubters, I guess, wanting to see what happens rather than just the rhetoric on the ground. What's the picture looking like this year in East Africa?
Thank you, Michael. So in Kenya, the big question in everyone's mind is the repayment of the Eurobond in June this year. The government is taking all the right steps and making all the right noises. So we're not expecting any defaults in Kenya. And of course, if they do repay the Eurobond, that will maintain investor confidence in the market. At the moment, all indications from the central bank are that the economy is stable, the banking sector is stable, and I expect that to continue. Interestingly, we didn't see a great use of the rescue processes under the Insolvency Act in 2023. The highest use we've seen of the rescue processes was just coming out of COVID. Then we saw a drop and then a marginal increase last year. This year, similar to what Jo said, we do expect to see more restructuring processes being undertaken because the business environment is generally challenging with all the macro economic activity taking place. But we expect to see more informal workouts rather than formal workouts, given the trend that's been going on in the last few years. We also expect to see a push towards updating the legislation to allow, for example, for fast-tracking administrations for companies that are in the small and medium enterprise sector.
I think that's quite an interesting regulatory development that we might need to look at in South Africa again when it comes to how different companies are being affected by these various local and global concerns. Maybe, Juliette, if you could kick us off, considering what we've just heard from Joyce and Jo and Stefan and the issues that they've raised, what do you two think we can expect from a South African perspective in terms of turnarounds and the options available to companies in distressed circumstances? Because as I said earlier, I get the feeling that straight after COVID, those that were deeply in debt and deeply in trouble kind of went into business rescue quite early. And I feel that there may be a few zombie companies out there that have really just been getting by, maybe even bordering on recklessly. And if we have another really tough year, we're likely to see an increased use of business rescue, for example. What do you see, Juliette, as the main options available?
For what it's worth, my prediction for 2024 is that we're likely to see an ongoing preference for informal restructurings rather than formal processes like business rescue and liquidation. And I think, firstly, this is because lenders generally prefer a more collaborative and consensual approach. I think also some lenders have not had particularly positive experiences with business rescue. In particular, they complain that it takes too long for these processes to complete and also that it's very expensive. I think there's also still some concern as to the quality and the skill sets of some BRPs. And, at the end of the day, Michael, trust is so critical for something like a business rescue process. And where that breaks down or the lack of transparency, creditors are generally left very unhappy. However, implementing informal restructurings does take time, and it's certainly not cheap, particularly where there are lots of professional advisors involved. And it isn't appropriate in circumstances where the financial distress is extreme and an urgent solution is required. It takes time. It isn't also appropriate where all the significant stakeholders are not on board and supportive of the process, because just one major creditor who isn't on board can completely thwart the process if they won't agree to a standstill while restructuring terms are negotiated, or if they won't agree to terms that all of the other stakeholders are on board with. Another thing I want to mention is we've also seen increasing interest in creditor compromises under Section 155 of the Companies Act. And I think that we may see more of these in 2024. The downside of creditor compromises is that there's no moratorium on creditor enforcement or action while you put in place the 155 process. And it unfortunately does take some time. That's partly because a 155 compromise requires the sanction of the court at the end of the process before it becomes effective. And as we know, court rolls are somewhat clogged, and it's very hard to persuade a court to hear matters on an urgent basis. So, hard to say, but we estimate that even under the best circumstances, you're going to look at a 2-month runway to implement a Section 155 compromise. And all of that time, you've got no moratorium on creditor action.
That's quite interesting, specifically around the informal process being the preferred route, given what we saw coming out of COVID and the rise of the chief restructuring officer. But I think we'll come to that. What was your next point going to be, Juliette?
It's not that there isn't a place for business rescues. I think it is fundamentally still an effective restructuring mechanism under the right circumstances. And there are instances where it is the best option, and one may be where creditors are about to enforce and you need the urgent protection that business rescue affords you, or when there just isn't time to negotiate a consensual process. I wanted to refer to the Deloitte restructuring survey last year that Jo obviously spearheaded. And there they referred to the fact that business rescue is suffering from a bit of an identity crisis. And what they meant by that is that so many people see a successful business rescue as meaning a process where a company or a business is actually saved, pops out of the end of the process as a solvent trading entity. But if you look at what the Companies Act says, it also contemplates that rescue can take the form of ensuring a better outcome for creditors and other stakeholders than liquidation would have resulted in. And we do see many of those being implemented. And I think we need to look at things through a slightly more generous lens and accept that under some circumstances, a better return for the stakeholders can still be regarded as a success. Obviously, we'd like to see businesses being saved, and one of the principal reasons for that is it saves jobs. And in an economy like ours, where there's such a high level of unemployment, obviously saving jobs is critical. But there are circumstances where business rescue even won't solve the situation. That's particularly so where people enter business rescue really late, where there's no liquidity and no easy access to post-commencement finance. And we know that in the South African market, unfortunately, accessing that post-commencement finance remains challenging. So I hate to mention the dirty word of liquidation, but there are instances where that will also be the only way out of financial distress. And I think what we need to bear in mind is that there are some cases where liquidation is the right route, and that's particularly where there's been instances of fraud or misappropriation of assets and funds, because a liquidator has tools in his toolbox to investigate and recover assets, which are not available to business rescue practitioners, for instance, and are certainly not available in a consensual restructuring environment. And Tobie, I think you probably also got some views on this.
Yeah, Juliette, I agree with you. I'm also worried, and as Michael mentioned in the beginning, I'm worried that a continuous trend for this year will be the persistence of zombie companies. Now, zombie companies are known as companies that earn just enough money to continue operating and servicing their debt, but are essentially financially distressed, and they continue to operate with the help of external support, such as loans, refinance arrangements, and payment holidays. Now, the term originated in Japan after the burst of the Japanese asset price bubble in 1991, where Japanese banks continued to support weak or failing firms instead of letting them go bankrupt. And to an extent, it's similar to what we experienced after COVID. I'm of the view that most of the zombie companies in South Africa have been financially distressed since before COVID, and that the lowering of interest rates and sympathetic market conditions during COVID allowed them to take advantage of the situation and to incur further credit at low interest rates. But now the South African companies or South African zombie companies must be unique, because a hike in interest rates will normally wipe out a significant number. But what's interesting to me is that despite a hike in interest rates, we still saw a drop in the number of filings for business rescue. So we know that South Africans and South African companies are extremely resilient. And perhaps, to quote Dricus du Plessis, it is as simple as concluding that they don't know what we know. Or perhaps, and similar to Japan, we are getting closer and closer to seeing the bubble bursting. But Michael, we often talk about how a delay in taking steps will hamper the chances of a business actually being rescued. And of course, one of the key benefits of early intervention is that there are more options available to the company for a successful turnaround. We've seen informal turnarounds work well in these instances, and even more so, an increase in the use of a chief restructuring officer in these informal turnaround scenarios. So Jo and Stefan, what are your thoughts on the CRO appointment route? I know that both of you have experience in that department, and maybe we can start with Jo. And asking Jo, what do you think? Do you think we'll see more CRO appointments in the informal restructuring space going forward?
Again, a difficult one to call because it's who is appointing CROs. And that tends to be quite lender driven. And again, that is going to be impacted by what their results are by putting in a CRO. The matters where we've been involved, where we've been appointed in a position similar to a CRO, we call it a restructuring office at Deloitte, are all lender driven. There has not been a single instance of a company putting up its hand and saying, I need help and advice to manage these choppy waters. So I would say those matters, and it's anecdotal evidence, it's the ones we've been involved with, have been more successful than formal processes like a business rescue, for example. So I'd hope that we would see more of them. But Juliette mentioned two things that for me are absolutely critical, fundamental to the success of that process. And that is stakeholder buy-in, and that is all of the stakeholders, whether it be your financial creditors, your trade creditors, your employees, directors, shareholders, unions. You need everybody playing together in order to have success during that process. And critical there really is the board, because unlike a business rescue practitioner, a CRO or an advisor in that position does not control the process. You still require board approval. And that for me is always where it can fall down. So you need a group of stakeholders moving in the same direction. And then you need time. You need to have sufficient runway to be able to negotiate that process such that you're not staring liquidity events in the face and constantly at the precipice of a business rescue. And those are two very difficult things to actually achieve. The stakeholder buy-in can, from a crisis management perspective and getting everybody on board and creating the necessary standstills that may be necessary, that can take weeks, if not months.
Yep.
And all through that time, everybody is well aware of the position of the entity. And then it just takes one creditor to step out of line and the process is sorted. But if you can demonstrate, and I think we can, that process is likely to result in higher recoveries and returns for all stakeholders, then I would hope we would see a greater volume of informal restructurings. because that is the process, in my opinion, which has the greatest likelihood of success.
That is such an interesting lesson that emerged from all of this. Stefan, would you agree with that? And the ability of the CRO to build consensus in a way that brings all stakeholders together? Because I think of the Constantia matter and how quickly they bled key staff. So you've got to have all of your stakeholders there, because if you lose your human capital, there's not much of a business case going forward. How do you view the role of the CRO and the lessons that we can learn from this as we look to build on into 2024?
Yeah, it's a very interesting topic, Michael. I mean, I think it's hotly debated at the moment. I would say it's almost a fixation or a fascination with a new mantle that is the chief restructuring officer that must be all things to all people. I'm currently holding any range of lead advisory matters. I'm also a CRO in a listed environment, and I'm also a rescue practitioner on another matter. And I think the answer for us as restructuring professionals is to pick the right remedy for the right situation. And I think the thought that one supersedes the other or is much better, I think is naive. I think we as a team on this call are talking about where the damage is in the business. I mean, if it's at early stages kind of warning signs in the income statement, very different to acute cash flow issues and not being able to pay the bills at the end of the month. And therefore, the tools and the powers that you need to be commensurate with the situation. The other point I'll make is that on the matter I've got as a CRO is within that group, it is a group CRO function, but we have other areas where subsidiaries are in business rescue and we're managing those. We've got others that we're winding down and others that will be part and parcel of the future of the business. So I think it's a little bit one-dimensional to imply that a CRO comes in, it's ABC, PTY, and that's the job in hand. I think typically we're talking about very large situations that warrant this ability to flex between the right process for the right situation. But I think it comes back to this mention about business rescue, and I guess falling out of love with rescue, and now the new hope is CRO. I think that really would be a naive read of the situation. We see plenty of good rescues, we see plenty of bad ones, we see good behind closed doors informal restructuring, and we see those that don't work so well. And I think time is the one that actually lets us know which of those come to pass. And I think we shouldn't be shy of the idea that you start in one position, but the circumstances go against you, and you might need to pivot from being CRO to passing it on into a more appropriate environment, being rescue. But I think it's a maturing situation. I think I'm glad we're embracing it as an industry. I think it should be mentioned that for 10, 20 years, I think that the rest of the world has had CROs. So it's not a new thing, but it is relatively new to us, and therefore shouldn't be seen as the savior of all businesses being, the new fixation. And therefore we set practitioners off against each other. Some of us do both, some of us do either.
I want to come back to you, Jo, just quickly. And, when we look at what are those critical success factors in the informal process that have led to CROs having relative buy-in and success, is it because it's maybe seen as a slightly less confrontational route where, if you're a large creditor and you just see business rescue, you think, directors are putting up a shield. And so from the get-go, there's maybe a little bit more distrust built into the process. What do you think it is about the CRO role that has engendered a higher tolerance for consensus seeking?
I'm pondering as you speak. I suppose in the matters where we've been involved in, what has led to that being the right process, I think that's what Stefan's, speaking about. It's horses for courses.
Yeah.
And there being sufficient time, or perhaps the challenge is one, it's just a balance sheet issue that needs to be negotiated, and we can do that with the financial creditors around a boardroom table instead of needing to go into a rescue process. Sometimes it's the industry or the sector. I mean, there's a couple where we were involved in now in the construction industry, and those are very challenging to emerge from rescue, but we can solve them consensually around the table with all of the financial parties at play. So whether it be your bond providers, your guarantee providers, and your lending institutions, those are the parties which we need to get consensus from. And in a rescue, it becomes a very different situation and scenario with those different parties. So it really does depend on the individual circumstances. But I mean, I'm definitely one that will say, if it's meant to be a liquidation, let it be a liquidation. If it fits the profile for a business rescue, let it be a business rescue. But if you've got the opportunity to keep it out of rescue and try and achieve something consensually, I personally would always try that first, unless you need, again, a moratorium or you need the protections of a business rescue. But then it fits that, it works in that bucket, and that's where I would go.
Yeah.
We need to get adept to using what's most appropriate in the set of circumstances and not avoiding a process for the wrong reasons. And I think, Juliette alluded to some of that. A lender looking at a business rescue and perhaps saying, do I have enough competent practitioners? The process takes too long. It's too costly. Are those the right reasons to be avoiding it?
Yeah.
Should we not be trying to fix some of those fundamentals?
Horses for courses, I think, is a really strong one, but it does come down to the jockey, which is the directors in this instance, being able to take appropriate action, whatever that action is, as early on in the piece as possible. That's certainly something that's come through quite strongly in the successful rescues that we've seen, or turnarounds, is that interventions were very early on in the piece, and there was still something to salvage. And I just want to leave you with this as we wrap up. I want to leave you with a thought, and it's that we're closer to 2050 than we are to 1990. Right, now that you feel a little bit older, hopefully you also realize how quickly the world can change. And I hope you're ready to seize that change, for change often brings with it opportunity. We're going to have to leave it there. That's all the time we have for today. Very interesting. Thank you all. Jo Mitchell-Marais, Deloitte Southern Africa, Africa Turnaround and Restructuring Leader, who is joined around the table by Stefan Smyth, who is a MD for Restructuring at Kroll, Joyce Mbui, a partner at the Bowmans Kenya office, Tobie Jordaan and Juliette de Hutton, who are partners at Bowmans. From me, Michael Avery, I hope you found some value in exchange for your time. Here's to seeing more rescue success stories in 2024. Take care.
If you would like to get in touch or find out more about Bowmans, please visit bowmanslaw.com.